Hello and welcome back to Dividend Destiny, the home of international income investing. Today we're going to review an article from the Financial Post, and I'll include the link in the description. They suggest that big dividend increases are coming as the big six banks are sitting on unheard of levels of excess capital. Dividend hikes, share buybacks and acquisitions are primary options of deploying billions in extra cash. And this is a Canadian article. The big six banks have a reputation as quality stock that have paid dividends for decades, robustly increased their payouts, and they are generally recommended as stalwarts of your portfolio. So the article continues. The largest lenders have tucked away $40.5 billion in excess common equity tier 1 capital, and they will explain what that is in a moment. The six biggest banks are sitting on billions of dollars in extra capital as the pandemic unwinds, and investors are wondering how the lenders intend to use those stashes of cash. The largest lenders have tucked away 40.5 billion, yep, just covered that part, in excess common equity tier 1 set 1 capital as of April 30. Set 1 capital is a fund of securities that regulators require banks to set aside during periods of economic strength as a shock absorber in a potential financial crisis. When the pandemic forced businesses to shutter and people to stay home, the banks started stockpiling billions of dollars to help them weather any losses. Canada's banking regulator even forced them to halt dividend increases and share buybacks to ensure the banks had enough equity in reserve. But the pandemic did not put as much pressure on the banks as expected. Yes, and if we go and check out just picking a random stock from the big six, you have the Canadian Imperial Bank of Commerce. And we can go on to the investor relations page and we'll just have a look at the dividend payouts. Alright, so we're on the dividend information page, common dividends, on CIBC's page. Now CIBC is the bank that I do all of my banking with. Had an eye on it for a while, given its yield. It's around 4% at the moment. But they've paid dividends. They haven't missed a regular dividend payment since its first one in 1868. 1868. So you're talking about, American Civil War era, which is remarkable. Absolutely remarkable. So they've actually kept the payments consistent, $1.46 per share per quarter since February. That was the declaration date, the payment date of April 28th, 2020. So yeah, just after the situation set in. And going back to the article, they're saying the pandemic did not put as much pressure on the banks as initially thought. The big six internally targeted an 11% set 1 ratio, but the lenders have barreled past that mark, booking an average 12.8% ratio with a combined total of $270.6 billion in set 1 capital, which is the highest on record. Compared to the regulatory standard, which currently sits at 9% after it was lowered by the Office of the Superintendent of Financial Institutions from 10.25% to encourage lending during the pandemic. The excess capital actually doubles to more than $82.4 billion. So let's look at this figure, which provides a nice explanation of the big six banks and their war chests. And you can see we have the excess here in light blue, above the 11% floor, and then the total in a darker shade of blue, the total excess above the 9% regulatory floor. So the six banks, if you're not already aware, are Bank of Montreal, Canadian Imperial Bank of Commerce, National Bank of Canada, Royal Bank of Canada, TD Bank, which is the Toronto Dominion Bank, which is probably the standout performer in terms of the bank stocks. It's a huge bank. And then the Bank of Nova Scotia. And you can see RBC and TD have huge reserves of capital, the excess of in excess of $20 billion. CIBC around 8.7. But I've just done some rough mathematics on the amount of capital if they were to actually return this capital to shareholders without allocating any to, say, buybacks or mergers and acquisitions. If they just completely gave the cash to shareholders. CIBC has around 449 million shares outstanding on the market. And if you actually divvy up that cash, it works out at around $19.37 on my sort of crude mathematics for distribution. And if they did do that, if they declared some special dividends, and let's say they only give out half of that, $10 a share, that's substantially more than the $6 or $7 that they're currently paying. It's essentially doubles the yield, doesn't it? So that's very exciting indeed. And then you look at the TD Bank, taking the opposite, a bank with a lot more capital. They have more shares outstanding on the market. They have around 1.8 billion shares on the market. And actually, if you divide the 23.7 billion of excess capital by those shares, you have around $13 per share. So actually it works out on a per share basis. They have less cash to distribute than CIBC. So this looks very promising from an investment perspective, especially given that these bank stocks are at all-time highs. Scotiabank analyst Manny Grauman says in an interview, these are unheard of levels of excess capital. The economy has held up a lot better than what anyone expected. The Canadian banks, in some sense, are reflecting that picture that's really true for the economy as a whole. For the banks, that excess capital isn't all good news. As the vaccine rollout ramps up and restrictions ease, the build-up could weigh on banks' balance sheets by reducing return on equity, a factor closely watched by investors. That's interesting. So it's going to reduce their return on equities from a stock perspective because they've got all of this capital on their balance sheet that they're not using. So it's going to reduce their efficiency on that metric. And certainly if you're looking for investments out there and you're doing the fundamental analysis on stocks, return on equity is a crucial marker of management effectiveness. And the banks are being asked to explain how they will deploy that extra cash and how those plans benefit shareholders. Ultimately, the banks have only a handful of paths from which to choose. The lenders could scoop up other companies or rivals, reinvest the funds into existing business, or send that money directly to shareholders by boosting dividend payments and buybacks. I personally would prefer the dividend payments. I prefer to have the cash in my brokerage account, and then I can use that for buying other things. I could use it for bills. I just like having the capital in my account. The potential for acquisitions garnered analyst attention during second quarter earning results released in late May, and TD Bank was the most bullish on its ability to go shopping, so I imagine they're thinking about mergers and acquisitions, buying smaller firms. With a 14.2% CET1 ratio, Canada's second largest lender has 14.6 billion in excess capital, the most out of the big six. The second highest ratio on the list belonged to Bank of Montreal at 13%, with the rest ranging between 12.2 and 12.8%. TD Chief Executive Officer Bharat Masrani said that the bank would consider returning capital to shareholders, but that it would not be shy to do a bank deal in the southeast United States or other region. Yes, they could obviously geographically diversify as well, which would be definitely a useful thing for the portfolio. But they're already a huge bank. From an M&A perspective, if something compelling emerges in the markets in which we operate, we'll have flexibility, Masrani said during a second quarter earnings call, adding that TD will also not be shy to return that to our shareholders. So that's very good, and certainly I will be looking for my own portfolio. I'm already looking at CIBC. I need to do some more work up on the fundamentals there and lay out the investment case. But TD I've been looking at for a very long time. Obviously with the recovery, the stock has barreled up to, all of these stocks have barreled up to all-time highs. So we'll have to see around the entry point, but they're such great stocks and the quality is there. They've paid dividends. All of them have paid dividends constantly throughout their existence. They would be lifelong holds for me, unless there's something, major black swan event that no one can predict that happens that wrecks the entire global system. Analysts overall think that TD has enough excess cash to both increase dividends and make a purchase. While strategic acquisitions that increase a bank's footprint could be lucrative in the long term, such deals tend to hurt share prices initially, but TD is sitting on enough extra cash that they would have the capacity to make a purchase, and it would make a good entry point, in my view, if the stocks did pull back. If you go through the history of Canadian bank M&A, initially reaction tends to be negative for the stock. Good, that helps us with an entry point. The stock market tends to look at these deals with a relatively short time horizon, so you could have a deal that the market doesn't like initially, but over time learns to love it or realise that it's an important strategic driver. There are a lot of questions around M&A, and the devil is in the detail. TD has been the most vocal on M&A, while the others have indicated varying degrees of dividend increases and buybacks, as well as investments in organic growth, are in the offing once restrictions are lifted, according to CIBC analyst Paul Holden. One commonality is that when allowed, the banks are all looking at significant dividend increases and in some cases significant share repurchases. We know that share repurchases increase the earnings per share on the market, so that actually the dividends, when they are announced, are increased as well because there's less shares outstanding and obviously more profits for each holder of stock. There are some differences in terms of preferences or thoughts between capital allocation for organic growth, M&A and buybacks. Some others are somewhat less enthusiastic about M&A, and others like National Bank will focus more on organic growth. RBC, which booked the third highest CET1 ratio at 12.8%, said that it has enough cash in both excess capital and internal organic growth to increase its dividend and buyback shares once regulators lift restrictions. But even that won't consume the remaining capital on its balance sheet, Royal Bank of Canada Chief Executive Officer Dave Mackay said, adding that Canada's largest bank is highly focused and very picky in its acquisition strategy. It's great to have the luxury to see accelerated organic growth to increase our dividend based on current core earnings and to return increasingly excess capital to our shareholders. OSFI has yet to announce when it intends to lift the restrictions, but analysts believe it could be later this year once pandemic-related shutdowns ease. As a result, the bank's payout ratios are below the typical 40 to 50% range, and Baskin Wealth Management Chief Investment Officer Barry Schwartz says that investors should expect large dividend increases as the lenders aim for the target. If you see the bank's payout ratios according to what they're expected to earn this year and next year, they're ridiculously low. There's big dividend increases coming. Okay, that sounds very, very promising, but it's going to be difficult to assume how much has been priced in at the moment, if that certainly is the case. It's if we look at CIBC on the market at the moment, CIBC price. Yeah, CIBC trading at all-time highs. PE of around 12. I've seen it at 10, 11 over the last 2 or 3 years. Dividend yield 4.13%. So if there's a pullback, that'll be a welcome pullback to get in, buy quality stocks at a cheaper price. And we look at TD. 3.6% yield, 11 PE. So they're trading at the average PEs. I mean, I could check it on Morningstar, but I don't think it's worthwhile for this video. I will address it in a specific stock valuation video later on. But certainly, you would not be remiss. But certainly the addition of any of these big six stocks to your portfolio as part of the financials allocation would be a very good strategic move just because of the robust cash flow that they generate. And if you're not based in Canada, if you're based in Europe, America, and elsewhere, they make an excellent addition to an international income portfolio if you want Canadian dollars in your asset base. I hope you enjoyed that analysis. You've been listening to Dividend Destiny.